Hello and welcome to the New Look Officials. I'm your host, Lisa Aziz, and joining me today in the Flux News studio, I'm delighted to say are leading officials. You know them already. Will Cunliffe, Hayden-Briffett, Spyridon Kokas. Welcome, guys. Good to see you. And of course, in this session, you will get all the info you need about the current state of the physical oil and derivatives market, so don't go anywhere. In this episode, we're going to be taking a deep dive into the latest developments, of course, naturally in oil markets. The officials will be discussing where prices are right now and, crucially, why, what's driving the market. After receiving Saudi OSPs last week, I'm sure you remember that, we will now, though, be discussing the new Saudi allocations to Asia and the recent Dubai window action. Right, let us get stuck in and catch up firstly with prices. Where are they at?
Yeah, so we've been in a pretty tight range up until yesterday. We were kind of grinding down towards that kind of $63 handle before prices burst up on the 11th, up to around $65, and we kind of broke that level only just, but that move was faded pretty quickly, and yeah, we dropped all the way down to $62 handle. So the prices have somewhat recovered since then, but I think this market really is kind of being driven by two forces. Really, you've got kind of quite a lot of support at the $60 level. That's driven by opportunistic buying. We saw the DOE come out yesterday announcing they're going to buy 1 million barrels of crude. That's not market moving news, really. 100 million barrels a day demand is pretty small, but it does show that you have that opportunistic buying at the bottom. And we know China like to do that too. And at the same time, we've got elevated sanctions, and we've got certain price action in the product market that's providing an uplift. I mean, Spiros, you saw the Chinese export quotas.
Yeah, definitely. I mean, that's actually the cute when we saw this flat price action that Brent went up. It was basically when we heard from market sources that because of Chinese refiners were exporting a lot during the first half of the year, due to their export quotas, they wouldn't be able to export as much of the clean products, so mainly gasoline, diesel, and jet fuel. Yeah. But we saw this steep drop from yesterday, and basically we heard from other market sources that China is now has allowed refiners to switch their low sulfur fuel oil export quotas with the clean product export quotas. So that means more supply in the market and obviously lower prices, because that's bearish. What do you think, Ed? What else have we seen in the price action recently?
Well, I think it's basically like Will says, it's been a recent kind of range we've been in. On the larger scale, it's been kind of 60 to 65. We've declined a bit from kind of September when we got to about 70 briefly, but it does seem like the kind of lower mid 60s is the comfy range. So coming back down to about 63.50 at the moment, that does seem quite good for the market. Like naturally, we have still this narrative of supply surplus, particularly next year. So the IEA is now expecting a more than 4 million barrel per day build supply excess next year. But we've also got, as Will says, this opportunistic buying because it's cheap, right? Oil's cheap, you're incentivized to buy, and that makes sense for China, it makes sense now for the US as well, trying to refill the SPR a bit. But I think generally we're in a bit of a holding pattern at the moment, and it will take
no particular shocks.
I don't think so. I think it will take a shock. Like the sanctions were a bit of a shock. We had an uplift from about 60 towards 65, but since then things have cooled off. The market's looking already for kind of workarounds. Although there are still ramifications coming out, so like the Lukoil situation in Iraq where they've declared force majeure, or the specific fuel stations in Bulgaria, Finland, etc. There are lots of ramifications that are kind of working their way out, but on the large scale, I think overall it's going to have a not especially massive impact on pricing.
Yeah, and we saw that in the last wave of Biden sanctions. We saw India scramble for PG grades immediately, and then pretty quickly rotated back to Russian after they realized actually the oil is still flowing. And I think we're seeing a similar pattern now.
Yeah, I think Asia does still have that desire to be buying, and like we saw that in the recent allocations as well. So yeah.
Well, talking of allocations mentioned there, thanks very much. What is the story there then?
Well, if you look at the headline, it says that we've got the lowest Saudi allocation to China that we've ever recorded as the official since we started recording them in July last year. So that looks pretty bearish. It looks like Saudis don't expect that much supply from, demand coming from China. But when you look at the bigger picture, Q4 year on year has actually had higher allocations because we had higher allocations for October, November. It's just December is 500,000 barrels lower than it was last year. So on the kind of aggregate, it's a bit higher.
And you also have to remember that, the Chinese refiners are getting towards the end of their import quota now. So a lot of them are kind of trying to finish that off, basically. And they might have front loaded a lot of that earlier in the quarter. As you can see, we've had very high allocations in kind of October and the last quarter in August as well. But you also have to remember that OSPs, which are kind of in some ways can be seen as a gauge of where the Saudis would place Chinese demand. They came out a bit firmer than structures implied, as we discussed last podcast.
Yeah. And you raised some interesting points. OSPs came firmer, and that implies demand in Asia is actually quite good. India, we've heard allocations to India were up significantly month to month, and Japan as well. So this demand. We see the Chinese allocations might be down, but Asia as a whole is actually remains robust. The demand is there. So the Saudis see something that obviously some of the market participants didn't really realize with these Chinese allocations.
And you mentioned as well the kind of finishing off their quota or their contractual agreement. I think an example of that was Rongsheng.
Yeah, exactly.
Because they're on the chart, they're normally the biggest one. They're the light blue bar.
Yeah.
So typically you'd see them taking a lot of barrels, like 14, 15, 16 million barrels each month. This month it was significantly lower. It was down at 8 or 9 million. Yeah. So that looks like a big decrease. It suggests on the surface lack of demand. However, we did hear that was to complete their kind of contractual quarterly and annual obligations, both on quota and kind of term lifting obligations. So really it's kind of, in that sense, that's somewhat mechanical and shouldn't worry the market too much.
Talking of worrying the market, what about people who are new to your show? Would they necessarily be worried about that? Or, we are approaching, as you say, year end.
I don't think you should be particularly worried about this because, as we said, compared to December last year, it's only 500,000 barrels less.
Which in the great scheme of things
it's not a big deal, really. It's down a lot from October and November because they were particularly high. So it's down 3.5 million barrels from November. So that month on month, it's big. Year on year, not so big. And as I said before, quarter on quarter on the aggregate of the 3 months, it's actually higher than 2024. So there is still some strength in China.
Yeah. Although I would also stress that for the most part of this year, we've had very big inventory builds in China. Especially in Q1, Q2, we had sort of 1.2 to 1.5 million barrels per day of believed SPR purchases. And, I think this is, in some ways, this could be a bit of a concern that perhaps China have taken the foot off the pedal in terms of SPR purchases. Perhaps they've rotated back some of that, some flows diverted from the PG grades back to Russia, perhaps. But I don't know. The window action, at least, from my perspective, it looks like China are being a little bit softer.
Yeah, well, some of the Chinese in Dubai, particularly, they've been on the sell side, right? And that's been kind of one of the narrative drivers in the Dubai window that we've seen recently.
Okay, let's move on. We've seen them reduced allocations to China. We've been discussing about that. But is that being reflected, say, in the spot market?
Well, definitely. I mean, the Dubai window action has been relatively strong. Obviously, not as strong as the previous month, but we've seen some increased demand mainly from Trafigura and Total right now. They're the main buyers of Upper Zakum because we had 13 convergences this month so far, all Upper Zakum.
Yeah, 5 of them this morning.
5 of them this morning, exactly. And we've seen players on the sell side. It's mostly Exxon, Phillips, we saw some BP this morning, but as you said, that mainly is China selling right now. PetroChina, interestingly, hasn't really stepped up compared to the previous months. They've been a net seller usually, and this month they've been very silent. That's fair to say, right?
Yeah, I mean, it's been a very different, welcome change on this in Dubai compared to last month. Last month we only had really Mercurius selling in the first half and then flipping to the buy side in the second half. They're still on the sell side, Mercuria, but yeah, you're right. Mostly it has been It's been the Chinese majors, and we've seen the premium take a hit off the back of that. We started very strong at the start of the month, but that collapsed pretty quickly, and now we're back down in this kind of mid 70 cents range on the premium. I mean, it looks like, looking at the chart here, it looks like that's a pretty well established floor, and I think probably going to find some support here, but.
Yeah, I'm inclined to agree. And as we look at their chart, and we mentioned previously that the OSPs were a bit stronger than the structure implied, you can see on the last, not this month, but the previous 2 months, so September and October trading, the drop in the average was about $1.60, but the Saudis actually cut by 120 and 140 for their grades to Asia, whether it's light or medium heavy, etc. So that's where kind of that structural argument comes into the OSP setting, into the allocation kind of process. But as you say, we had a very strong start to the month because we had a really choppy end of last month, and that fed into the beginning of this month, and then we had a pretty dramatic fall. Since about the second or third session, we've been gradually grinding lower, and as you say, we're stuck now in kind of the mid 70 cent range. I think it was 75.5 cents this morning, assessed by us, and it is dragging down the average because, as you can see, we're like 113 or so on the average for this month. That's distorted by the early assessment, which I think was above $3 for the first session. So that'll be an interesting one, how the Saudis actually manage that in terms of the next OSPs.
When you see a drop like that, though, I mean, to me, talking to you experts, it does look pretty dramatic. So one wonders what the drivers will have been there.
I mean, spreads remain depressed all over the world. We see WTI spreads and Brent spreads are around, for example, Brent is around 25 cents for the prompt spread, up to 30.
WTI went contango today.
WTI went in contango yesterday, and it's trading around parity right now. So basically the question is, how much oil is on water right now? How much oil is in transit, and how much oil is just left on tankers that are not moving? That's the main question. Everybody has been talking about this super glut. We saw this various agencies coming with almost $5 million barrel builds heading into Q1 next year. So that's the main theme right now, and the market tries to understand where we're heading next. So that's why the spreads remain quite tight right now.
I would like to challenge that oil on water narrative though, because it's been going for probably a month now, and it's been this kind of big discussion about how much oil is literally on the sea, traveling or in floating storage. And I saw a story this morning about JP Morgan saying something like a third of Russian export capacity was on water. And that's like millions of barrels per day, 1.5 million barrels per day. That doesn't really make sense just from a logistical point of view. It can't be just sitting on ships. There, for one thing, aren't enough ships, and it's way too expensive.
And also, that means that pretty like last month, there was a notable uptick in production. We're not seeing that come through in any of the production data. So it's okay. Yeah, we've had this huge accumulation supposedly of oil on the water, but where did that oil actually come from, and where's it going? I mean, we know that refineries are in turnaround at the moment, hence why refinery margins are so high. So to me, that narrative doesn't necessarily make that much sense, and it kind of it comes back to this. As you talked about the super glut, right? That has been a narrative that's been building for kind of the past 2 quarters, really. We started to see global balances, projected global balances turn into surplus earlier in the year, and they've only got deeper and deeper into surplus. And now we're at the place where the IEA, and I think it was Macquarie, who were projecting, 4+ million barrel builds for Q1 next year.
Yeah.
A story like that, though, could it just be wrong? Could it just be fake?
Yeah, it could be fake.
You're experts and you're saying you don't know where that's come from. Could it just be wrong?
It could be wrong. It could just be a misinterpretation of the data. It could just be understanding of the numbers, because if you have X amount of refinery capacity taken offline in Russia by Ukrainian drone strikes, you then perhaps assume that it's immediately going into exports. Might not necessarily be the case, and it can just be an error in the arithmetic.
Yeah, and I mean, I think the fundamental picture at the moment is not great. Like from a macro perspective, we have pretty soft data coming out about the labor market in the US, with China as well. We got their new yuan loan growth today, and that's continued to downtrend. I mean, that's the weakest since the data started, now at 6.5% year on year, and disappointing to the downside. And that, for me, that's the main barometer of the health of the consumer base in China. And the fact that that is not ticking up, I think, is very concerning. So yeah, demand is soft, but I think what a lot of people are missing is that the supply narrative hasn't really changed that much. We've got a little bit more coming out of the Saudis. We've got a little bit more coming out of US shale. But other than that, I mean, where are you seeing all of this extra supply growth come from?
I mean, everybody's talking about these OPEC quotas, right? So we know these are paper barrels. We know some of those countries already produce even more than what they report they produce. So quite frankly, these numbers are just totally fake. We shouldn't even consider those.
Yeah, I think the most laughable one is the Kazakhstan compensation schedule, where they say that in like June, July next year, they're going to reduce production by 650,000 barrels per day to compensate for previous overproduction. I think really one of the only places that you can actually see more production come out is Guyana. I mean, they've just brought online a new stream. I think it's called Yellowtail, or Golden Arrowhead, sorry. Yeah. And that's one where it is actually increasing production, but on the aggregate, that's not going to make a huge difference to justify these 4 million barrel build.
5 million barrel build, no.
Right. Well, that just about sums up Dubai and more. What about the North Sea?
Well, that's been a fun ride the last week or so. Yeah, so I mean, as you can see on the chart, the dated Brent physical differential, well, it dive bombed, completely collapsed. That's the softest physical differential we've had since we started tracking. I mean, below -$1. And I mean, what we've seen Vitol dumping a lot of Midland in the window. I mean, they pulled cargoes from chains, didn't they, Spiros?
Yeah, they did. I think from chains was at least 13, let's say.
Yeah,
at least
13 to 15, something
13 to 15. They also bought last week 2 Midland cargoes on the window, so call it 15, 17 cargoes they had, and now they've started selling. We heard from some trading sources, they on paper, they had a very large short position.
Yeah.
So that implies some traders were already expecting that big drop to happen from Thursday, Friday, which did actually. But on Monday it was a shock. It was a nice mix of all the grades being, especially Midland, being deeply negatively offered on a full basis.
I mean, Ecofisk and Midland, they were the softest, I think, since 2021, right? So, I mean, this is a big move. I mean, from trading sources that I've been speaking to, I think, Vitol probably aren't going to be so actively offering next week. So perhaps we see a return back to more neutral physical differential. But yeah, I mean, it's violent move.
Yeah, and it's been pretty choppy actually lately through kind of the end of September, as you can see on the chart. We had a big jump, bit of consolidation, sudden drop, aggressive jump up again, then this Armageddon kind of situation. We had to extend the axis on the graph because it went off the bottom. But yeah, I think I agree that Vitol's probably had its fun now. Maybe we'll take a step back. We could see a bit of a consolidation in the diff rising towards more normal levels. But that does require somebody to be brave and come and bid.
Yeah, exactly.
With the threat looming that they know that Vitol has been just so aggressive recently. No, it could be anybody, but someone brave.
And Vitol, yeah, they've been selling a lot, but they still have a lot of bullets left.
Exactly.
I believe they have, 17 cargoes?
Yeah, with what we've seen in the window, they haven't sold many Midland. From memory, it's like 3, 4 maybe, if I'm not mistaken.
Yeah.
So they should have more bullets, as you say, Will, rightly. Obviously, over the counter, that's a different story that we can only listen to trading sources. But I believe I'm also inclined, as Ed mentioned, that we should see some recovery now going forward.
My next question would be really the 40s curve and how that relates to Midland, because we saw Midland get slammed really aggressively early this week, but 40s has also been descending to become more competitive against Midland again. So I think if we see some bids coming in for Midland, we could end up seeing 40s begin to set at least some of the curve, maybe the whole thing. But I think it's at the back principally that 40s is closely competitive against Midland. So that will be one to watch, the intergrade dynamic there.
When a chart then literally drops off a cliff like that, give the viewers a sense of sentiment on the desk. Do you all go silent, just look at each other? Is it a scary moment?
I mean, we're kind of building the curves, right? So we're looking, okay, so where was the CFD trading? And we were like, wow, the front's pretty negative. Where's the cash spread? Okay, that's still around like 30 cents, so nothing to worry about there. And then you're like, wow, okay, so a lot of these trades were done a BFOE related, not a data related. So we're there working out what that implies data related, building the curve, and Midland was absolutely crushed. It was like, everyone get round, look at this.
I bet.
One of the other factors is as well freight. Freight is so expensive.
Freight's so expensive.
I mean, the Sullenbo Rotterdam route is getting near $2. That's the highest we've seen in a long time. I can't remember when it has been as high as that. Certainly not for a long time. So that's another factor when you have to consider the CIF to FOB conversion. And I think freight being expensive has been a narrative as well in the market the last couple of months as well.
Well, again, it comes back to sanctions, doesn't it? I mean, the amount of unsanctioned dirty tankerage is decreasing pretty rapidly, at least more rapidly than new dirty tankerage is coming onto the scene. So that's going to constrain.
Well, yeah, 9 times out of 10 it comes back to some geopolitical story, doesn't
At least, obviously, with the tankers, we had some interesting stories this week. It was China, right? They announced that they would cancel those port fees that they had implemented to the US. So that's a positive. That's a positive piece of information that we received.
Definitely.
We see some sort of recovery in those relationships. They started buying soybeans, they started buying other products, they cancelled the port fees. The US quite similarly is moving in that direction, trying to build the relationship. So the sanction ships, that's a big question, but at least from the Asia and the US side, it seems like everything is slightly heading towards better outcome.
We can hope.
I think we can have a whole show just on those ships. Be good. Just finally then, to the story of the week.
Well, I think it's got to be gas oil. That's been absolutely ripping the past past month and a half, I'd say. And then the news came about the Chinese quotas, and it softened a little bit. We're seeing a bit of a reversal and now consolidation today. So we ripped up to almost it was $42.
The prompt heating oil swap crack, as you say, got up to almost $42 on, what was it, Tuesday. And it was already at very elevated levels because, as you can see on the chart, we'd been spending most of September, October, $30 a barrel kind of area. That was after having jumped on the Israel-Iran war back in June. It hadn't really come off that much
already
since then during the summer. So it was already pretty elevated. Then we get this kind of continuous, steady rapid rally up towards 40, and then the sanctions as well don't help that situation. In kind of late October, they help to boost it more, and up to nearly $42. And I think a lot of it comes down to the sanctions, refinery maintenance in key kind of swing barrel areas, like we saw Al Zour refinery in Kuwait. That's not expected to come back online until 9th of December, according to our sources. India as well has had some unplanned maintenance, plus of course the stocks story in the US.
And heavy turnarounds in Europe, Dangote offline. There's a lot of maintenance at the moment, which has been kind of pretty constructive. A lot of product cracks. I think also from a technical perspective, a lot of people were starting to get short gas oil and heating oil. I think it was seen to be a little bit overextended. So it just needed that one little impulse to kind of trigger those stops and then see that dramatic move to the upside. And people I've spoke to, a lot have been burned on that trade.
Last word?
Over to stocks. I mean, we expect the EIA stocks to come at 3:30 UK time. Obviously, this podcast is recorded a bit earlier, so we've seen here the stocks are running below the average, below the 4 or 5 year averages, and we are pretty bad right now. Distillate stocks in the US are very, very low, and obviously that's another that's obviously put upward pressure on heating oil. And quite frankly, it would be interesting to see where the EIA stocks come this week. But I believe this heating oil swap crack should trade around an elevated range for the time.
I think as well as noting that the stocks are low, I think what you have to look at is the rate that they've been depleted. And if you compare, so the red line to the black dotted line is the average of 2020 to 2024, whereas 2025, you can see that they were actually quite close, kind of early October, end of September, and then suddenly this year they've just been depleted repeatedly and rapidly, and that I think is causing some concern. So it's at a faster than usual seasonal rate.
Yeah, well, I mean, we've had a pretty severe kind of cold weather snap in the US, which I think has driven a lot of that accelerated depletion. It'll be interesting. I mean, it's expected to not necessarily be maintained throughout the cold winter season. It's not meant to be as severe necessarily as what we've seen so far. So it'll be interesting to see if they can up refinery utilization a bit. I mean, the cracks are so strong. I don't know why the refineries wouldn't increase their utilization, but that's been pretty soft in recent EIA prints.
Yeah, you should be right about the capacity right now. If you're a refiner. But it's interesting also over Europe. You mentioned Finland is actually, from memory, at least 20% of pump stations are actually affected by Lukoil, so that implies more diesel demand obviously in Europe. Now with Bulgaria, we don't really know what's the situation. We've been hearing a couple of stories. So yeah, it's interesting to see how those sanctions will play. Europe is definitely affected by that. Also, Al Zour Refinery, Europe is a major importer of gas oil and jet from Kuwait. So yeah, it will be interesting to see.
Yeah, I'd like to kind of soften that slightly though, because unlike the US, where we've seen these repeated significant draws on the distillate stocks, gas oil stocks in ARA have actually got to above their 5-year average. So there is a bit of a cushion, but there is still, I think, in the market's mind, a lot of concern about the Russia sanctions, both in terms of secondary sanctions on particularly Indian and Turkish refined diesel, plus, of course, just the direct consequence on distillate pricing, because a lot of it is obviously medium sour and yields gas oil. So Europe has a bit of a cushion, but it shouldn't feel too comfortable because it is cold out there.
We'll see if it all remains comfy. Thank you so much, because that is it for this particular session of The Officials. Remember, you can see all of our Flux Live shows on whatever platform you wish, whenever you want. And remember too, if you've got any questions or comments, get them into us, get involved. We will see you next time.